Let me pull up a chart that shows exactly that 5-year break even, just topping the 2008 high. It's now at 2006 highs. Really, we are seeing these expectations now at 15-year highs, as you can see in that chart. So how does this inform your investing outlook? Do you have greater conviction now when it comes to cyclicals? And, I suppose the next part of my question is going to be how much further downside is there for some of the growth-sensitive stocks?
Good morning, Heidi. I think this, growth versus value debate has ebbed and flowed this year, but I think the reinforcing nature of what we're seeing in terms of the inflation outlook, the fact that it'll feed through into yields and potentially changes to central bank policy does really much focus our attention mostly on those cyclical and value plays and that rotation that will continue around the world. And importantly, it's not all happening at the same time. It has been led by the recovery in China. We've seen it play through the US, and now we'll see it move into Europe. And that does mean that rotation can keep going, it can keep shifting, and it does create opportunity for investors. And it also means that there's room for equity markets to move higher, even if we do see some sectors around tech and some of those growthier start to feel the pinch of those higher yields. I think crucially for many investors will not just be thinking about that rotation, but be looking at the companies that can actually offset some of those price pressures, whether it be through wages or inputs, in terms of the earnings outlook.
So when it comes to the tech names, we have seen the FANG Plus as well as chip stocks now falling below 50 and also their 200 DMAs. At what point do you look at these stocks and think, well, actually, not to talk about a bargain, but would you buy on the dips given the prospects for long-term, disruption and growth post-pandemic? They really haven't changed.
No, I think a lot of the secular themes about why people liked a lot of these sort of technology-orientated names before the pandemic are still very much there. What changed was the valuations that moved aggressively higher in the early part of 2020. And as those valuations come down, there will still be attractive opportunities when we think about the technology surrounding sort of artificial intelligence, cloud computing, payment systems. All these things will come back through. And I think that it's just a case of finding the right price. As yields do move higher and as these inflation expectations rise, unfortunately, it does feel like the case that, the tech sector will start to be weighed on more heavily and everything may get dragged down with that. So I think it will be a case of thinking about the opportunity and when it does come through and allowing the market to settle a little bit more on that inflation outlook and digest some more of the news around the Federal Reserve and other central banks' policy and if they're going to change in light of these inflation expectations, perhaps before moving right back into that sector. But I do believe there's still a lot of those secular stories there which are quite strong, which will come back as the valuations come down.
Does that mean that we should be more positive about those tech-heavy indices broadly, like Taiwan or Korea? This GTV chart on the Bloomberg already showing that the Kospi has hit an all-time high.
I think the reason we would look at sort of these markets and say, why do we find them favorable in the broader Asian context is really because of the way they've handled the coronavirus, the fact that you do see a lot of feed through from demand in developed markets, which is still coming back through. I mean, obviously semiconductors being key there, but these are parts of the world which are going to benefit mostly from the lift in global growth, particularly in Europe and the US. And they're not seeing the same drag from the viral spread that you might be seeing in other parts of Asia. So there's keen supports for these North Asian markets still very much there. We do expect those to perform quite well as we look at the rest of this year, whereas, we contrast that with some of the Asian markets in Southern Asia and think about some of the drags of the coronavirus, which will still be prevalent, and the divergence that's most likely to happen across EM because of that.
How do you like Europe?
Kerry.
Europe is looking quite favorable. Obviously, if we look at some of the performance of, say, MSCI Eurozone, it's actually been very good this year. It's slightly outperformed the US. If we think about the MSCI US in dollar terms, a lot of that strength has been there because of the reopening. We've also seen the euro come up quite a lot in the last sort of 6 weeks or so as people focus on the potential there. I mean, Europe is an index, an equity index at least, that has a greater weighting towards those cyclical sectors, materials, financials, and it should stand to benefit. And it doesn't have that big weight of the tech sector, which could be impinged by those higher yields. it has its own problems with the growth outlook and the inflation outlook being very, very low. But we're offsetting that against some of the political developments, the European Recovery Fund, which is going to stoke that growth. And again, that rotation that's been China-US is now moving into Europe. And we would see that become another cylinder in the engine of growth across the rest of this year, and definitely an opportunity for performance to come back in terms of the market at lower valuations that you may see elsewhere in the world.
Kerry, in terms of opportunities, of course, it feels like we've been range-bound in Australia for a long time. We finally had that record close. It is budget day. We're expecting, a bumper budget in terms of just the recovery from the pandemic and the commodity cycle doing so much better than expected. Is this finally the catalyst for a breakout for Aussie stocks? And what are you liking?
Oh, well, I think it was always in terms of budget. There's, so much more news has come out before the actual release. I'm not too sure how much more positive the market can be. And also, we're thinking about those commodity prices lifting the market. Certainly there's support from them as long as we have that imbalance between supply and demand at the moment, which is really, what's behind a lot of these commodity price moves. I think when I look at the iron ore price in particular, it's some of the concerns about the the Australian-Chinese relationship at the political level, and the fact that, an iron ore price that high is not great for China, and they may start to try and talk it down, or at least make moves to try and bring out some of the heat of that, which could weigh on the market as well. Fundamentally, we do believe there's going to be a good story around the materials sector because of these prices. They can stay elevated for a little bit longer. There's certainly still demand there, but they have become quite high, and we would see scope for perhaps a bit of a pullback on that, which could weigh on the Australian market. And at the same time, we do think about the prospect for the government to spend here, but also realizing that they are pretty much focused on the size of that budget deficit, and probably aren't going to go all-out spending in terms of what we've seen in other markets around the world, and maybe a little bit more reserved compared to what we say in the US, for example.